Good afternoon, folks. Thank you for coming. Appreciate it. And hope you get a lot out of this. One of the best ways is to ask questions. We've got a handout that has copies of all the slides in place for you to take notes if you like. And a feedback form just to let Sammy know. And we want to thank Goosefoot for inviting us to come talk to people every 2 weeks for at least in the conceivable future, like through April. We're going to be doing different topics. Today is Schedule C and other small business taxes. Schedule C, I'm going to go into as much as I can about it. Any of you folks thinking about farming? Okay, there's a special version, a way to think of it, of this Schedule C called Schedule F, pretty conveniently for farm. So if you are involved in farming, you're going to find there's just a different version, and 90% of what I'm going to say is going to apply. However, there's going to be special rules for farms that allow farms to actually get some extra benefits to reduce the taxes. And that's kind of the goal here. Don't pay the IRS more than you should. You probably might be surprised to hear an IRS employee say that, but it's your right. It's one of your rights. There are 10 rights spelled out of taxpayers that Congress put into law to make sure the IRS doesn't treat people unfairly. And part of that is your rights to not pay more than the right amount of tax, among many others. A little bit about how I got into this. 14 years with the IRS. Most of my career has been in collections. I've been in an outreach position now. This is my role is communications and liaison, basically meeting with the community so that we can help people understand taxes and encourage small businesses specifically here. One of the things, though, that I found as being someone in collections was anybody who had difficulty with their taxes and ended up with a surprise tax bill, I found upwards of 95%. They were not trying to be public enemy number one and pull something over on anybody. It's just that tax code is not simple. It's complicated. If you've got a tax law question, you can go online and get all kinds of answers, some of them contradicting one another. And I found this comic, thought it was really funny. The guy said, well, simple but wrong answers can go that way, but complex but right means you got a lot of reading to do and you might take a different path. But that's my goal, is to try to translate. In my time in the IRS, I've kind of have learned a lot. When I first started, I thought, do I really want to get involved with the government? And then do I really want to sign up for this part of the government? Well, I needed a job, so I tried it. And over time, the mysterious nature of all these legal terms and things that I didn't know slowly became more apparent. And after a couple of years, I just felt really comfortable with IRS speak. But I also know normal people, and I'm a taxpayer myself, so I want to understand what's going on with it as well. And so translating from these terms into English is part of what we're going to do today. One big disclaimer, I don't want you to think that I'm the be all end all of anything. Really all I'm trying to do is just give you some guidance. And all of this guidance is published at irs.gov. Congress requires that the IRS not keep tax law secret. It is all published. And so you'll find at irs.gov, if you've ever been there, it's just jammed with layers and layers and layers of material stacked right on one another. So it's not necessarily a short list of things to look at. It's pretty big. However, it's all required to be there. And so anything I do tell you, go to irs.gov, ask your tax professional, your accountant, get clarity. I was just discussing earlier this morning about how, you may even go to a tax lawyer or an accountant, and maybe you're shopping 2 different accountants, you get different answers from each. It's so complicated that you are going to get different opinions. However, a lot of times you get what you pay for. And even if you have an accountant, I recommend educating yourself so you know what they're doing for you, so that you know where they're heading, so that you know what you might want. I'm going to simplify a lot of things, and that's why my guidance is just not going to be concretely reliable. For that matter, there's 300 million taxpayers including individuals and businesses in the United States. That means there's 300 million different situations. So I'm nowhere near qualified to know 300 million different situations. As a business owner, you'll know your business best. So pick what applies. How you doing? Morning. Handouts and a sign-up sheet if you like. So we're IRS.gov. So what are we going to cover today? Some of the biggest tax deductions or tax credits. So first I need to start out with two vocabulary words, a deduction and a tax credit. A deduction is something you take out of your income. Think business expenses. You paid money. And the simplest way to think of something that's easily deductible is you bought a product and you're just going to sell this to a customer. And you put your profit and your margin on there, et cetera, charge them maybe state sales tax, right? Things like that. But the cost of that product, you shouldn't get taxed on the whole cost of the product. If something costs you $50 and you mark it for $100, that $50 extra is your profit, takes care of keeping your business so you can buy more product. But that $50 it cost you should not pay taxes as if you received that. And we're going to talk about a lot more of these deductions. The biggest one right now is what's called qualified business income deduction. And right out the gate, I feel like the IRS made this challenge here. QBI, this new term, what's qualified, what's not qualified? Well, the reason this is put in there is because that's a 20% reduction, a deduction from your income. 20% right off the top. This is to help small businesses grow and operate with a built-in margin given by the government, 20% right off the top. Qualified just simply means a certain type of income. So it's things like selling a product, marketing a service. However, there are certain services that are excluded from this. Attorneys and specifically investment firms. If you get a majority of your business is getting revenue from investments you've made, they're not allowing that. And think about, a giant company that only does investments. Well, to say 20% right off the top is not taxable might end up being a lot fewer big businesses being taxed. And so specific industries carved out there that aren't eligible, but you'll find most businesses do qualify for that big 20% right off the top as a deduction. I'm going to be focusing primarily in this class on Schedule C. And like I said, for farming, there's Schedule F. Very similar, but essentially they are your costs, your deductions, the things that come out of, they're your costs of doing business. And I've got copies of those. In fact, I should have put them with the handouts, but I'll hand these out right now. Since you're in farming, I'll give you the Schedule F. And then these are Schedule C. This is the one that we're going to be covering for most of the class. It's where you show the government what you are deducting, what you're taking out. And, oh, excuse me. Sorry. Did I give everybody the right form? Did I give? Yeah. Yeah, you should have 2 pages of the Schedule F. I'm sorry, I don't. I only brought one. Oh, for that matter, like I mentioned, IRS.gov, you can get it right off there. Forms and publications, and just put in Schedule C. There also is an accompanying instructions for the Schedule C. So be sure to look at both. It is what's used to tell the IRS when you sign that document, you're saying, hey, to the best of my knowledge, this is right, this is correct. So that's where you're going to show what your profit is and what your income is. And so the difference, another vocabulary term, profit, that's what you get to take home. That's what you use to pay your personal bills, not the business bills. Your rent, your mortgage, your car payment, your insurance, your kids' tuition, groceries. That's profit. Income and revenue are going to be pretty closely related in meaning, but that's basically how much you took in, right? But that doesn't mean that that's the part that's taxable. And that's what this Schedule C is for, to show the difference between gross income and net income or profit. That's what we mean by figuring out net profit. And if you're having a bad year, or maybe you just got started, it's not unusual in your first couple of years to show a loss. And that's also what this Schedule C can show. It could show a negative number, right? I pulled in $100,000. I spent $125,000 over the year. I lost 25 grand. Where did it come from? Well, that was the investment money that you put into it. Maybe you bought a ton of product up front. Maybe you bought a big piece of equipment up front. Maybe you bought property. There's all kinds of costs. And maybe in your first couple of years, you have a loss. That actually comes out of any other income path. And then basically everything on the Schedule C or the Schedule F gets transferred over to your 1040 if you were a sole proprietor. Okay. This class is primarily for sole proprietors. Even if you're an LLC, you can choose to be taxed a different way by the IRS. And most businesses are going to find that sole proprietorships are going to have fewer documents to file during the year, easier record keeping. In other words, for most sole proprietors, the business is me. It's my service. I'm the one who turns the wrenches. I'm the one who meets with the folks, who sells, whatever. And that's why it's reported on your 1040 under your Social Security number. But you might also have an EIN, an employer ID number. A lot of banks are going to want this if you want funding. And if you're employing other people beside yourself, employer ID numbers is necessary as well. But most of this is going to be covered under self-employment. And even if you're an LLC, you could tell the IRS, want to be taxed as a sole proprietorship. So you'll also do a Schedule SE, and it's a lot simpler form. It just pulls the number at the bottom line of the Schedule C, and that's your self-employment tax. Think about your Social Security and your Medicare. If you work for an employer, they're pulling that out. They're also pulling out your withholding, right? So self-employment tax is your way of contributing to your own Social Security. If you're a sole proprietor and you make a bunch of income on your business, that credits towards your Social Security, and these Schedule C impact what you're going to pay and what you'll pay not only on income tax, but self-employment tax. Estimated tax is what you pay along the way, right? Think of your W-2 if you're a wage earner. If you're a wage earner, your employer is deducting Social Security and Medicare and your withholding. And think of the estimated tax a lot like your withholding. That's money you are putting into the system to pay ahead. We recommend quarterly, 4 times a year for businesses. And one of the reasons that I think this is very important is you don't want to come up with all the tax at the end of the year, especially if you made a better profit than you thought you did, because it's a lot easier to come up with a little bit out of each job than to come up with it all in April or when you file. So estimated taxes we'll talk a little bit about as well. All of your income tax decisions are based on what your business structure is. And sole proprietorship is how most people start. It's the easiest record keeping, and it is, I'd say, going to give you about as much benefit for small business. And by small, I mean pretty much everybody below, Boeing and Zillow and Amazon level, right? I mean, it's big business is considered much higher than what we're talking about. Even if you're very successful, most likely you're falling what we call small business.
Everybody in this room falls under what most of our government structures actually call micro.
Okay. So for business structures, sole proprietorships are what most people are. This is a copy of the Schedule C. Yeah, that's the one we're going to look at most. Partnerships are less common anymore. They don't provide as many legal protections. Also, they have a very strange, every partner in a business, if you are classified as a partnership, you're responsible for the decisions of every other partner. So if one of your partners signs a contract obligating your business to some debt that you didn't agree with, you're responsible because of the nature of a partnership. That's not as common anymore. But an LLC is a state level determination. That's kind of what has taken over. But you can be taxed as a sole proprietor and be an LLC, or you could be an LLC and be taxed as an S corporation. This might be something you might consider as your business grows. And I think you could do the math yourself. It's just a bunch of math problems, probably like 3 or 4. But what you're determining is my business big enough where the extra burden of record keeping and forms that you've got for an S corp justifies me taking the extra time during the year being an S corp. Because even if you're just one person and you're making as a profit about $100,000, it starts paying off at about $70,000, but it's a small dollar amount. You might save a few $100s on your taxes. But as you graduate and if you're taking home from your business after all your costs and taxes, 100,000 or more, investigating S corp might benefit you for. It's a different form, but it covers a lot of the things we're covering in principle on the Schedule C. Your deductions are still deductions. If you're an S corp, you don't want to pay taxes on costs of doing business. You want to pay it on profit only. So a lot of the principles are still going to be the same, even though the Schedule C specifically won't be involved in being an S corp. Corporations, that's where the corporation itself pays the income tax. An S corp, the individual still pays the income tax, whatever individual owns it. If you and your spouse own a business, you're paying it on your married filing joint tax return. But if you're an S corporation, the S corporation doesn't pay any tax. But if you're a C corporation, C corp pays its tax right up front. And most of your giant businesses operate this way because their ownership is completely different. They're owned by like stockholders, et cetera. So very uncommon that a small business wants to be taxed as a C corp. You'll probably pay more in taxes. Again, consult your advisor, but consult our website. All this info is here under irs.gov/small biz, SMALLBIZ, and you could research that. This right here is drilling down to what does an S corp have that's different? Well, they have at least 6 different forms here. But for sole proprietors, it's also going to let you know what yours are going to be. And usually it's about 3 forms. Your 1040, which you usually file anyway as a taxpayer, your Schedule C, and your Schedule SE for self-employment. A lot simpler. So the qualified business income deduction, it's a huge number, 20% of your qualified business income. So it doesn't account for the interest you might get from the bank, which may not be very much. It doesn't account for other types of investment income, but it covers most types of things. And you could start seeing down below how some of these get limited or changed. So if you're a real estate investment trust, if that's your business, then only portions of that get deducted, but might not apply to everyone. If you do, research it yourself. But we're going to be covering any owners of sole proprietorships, partnerships, S corps, and trusts and estates. And so this should apply to most. For more information, you could read the law itself, section 199A, very dry stuff. But our website, irs.gov, does have a lot of info about the qualified business income deduction. And there's a pretty simple way to calculate it, but think of it like this. I took in $100,000 in gross revenue. 20% comes right off the top as the QBI. That means you're left with $80,000 that you will account for in paying taxes. Okay. C corps, not eligible. It's a fairly new deduction. So it's only been available since 2017. As of right now, it's extended to the 2024 filing season. So you can use it when you file for this past year that we just ended. However, we don't know yet if it will be extended for 25 and onward. We do expect that it will continue because it's fairly well favored by business and the business community. So what is it? It's the net amount of your income, your gains, your deductions, or loss. It's basically restricted to businesses and trades within the United States. If you have any, you may have a business outside, maybe Canada, that's close to us. You're going to have to just do some math and see what part of it is for the trade within the United States. So a very important deduction here. And so this is one that you want to take right off the top, even before you start deducting your costs of doing business like the Schedule C. So basically what you're going to be calculating is things like how many deductions are applied. In other words, all the deductions should be applied first through your Schedule C to know what your qualified business income actually is. You're going to be doing, there's a worksheet for this, again, part of our website, and you could just either put in qualified business income or Section 199A, and there's plenty of stuff on there to calculate. It's about how much my business had as income. For self-employed folks, there are some deductions, retirement plans, even for yourself. It's a great way to plan ahead. And it's like giving yourself income from your business, but not paying taxes on it this year. You won't pay taxes until you withdraw it when you're retired. And maybe in retirement, your income and costs will be less so that you'll pay less taxes when you retire. In theory, it can help you save. I think it should say employee plans or something like that. Yeah, here we go. 19. Line 19, pension and profit sharing plans. Okay, you'll probably, and if you're going to be doing a SEP, IRA, self-employed IRA, or any of these other retirement type plans, then you'll probably have another document to add to it. But still, hey, you're paying it. It's a benefit to employees, even if you're effectively the employee.
So for the question.
Yeah.
For the F, Schedule F, we're filing both Schedule C and Schedule F.
Sometimes.
In addition to Schedule C?
Not necessarily. Your business might be completely just farming. And so Schedule F may be enough. If your business has other aspects that you want to kind of separate out, like maybe you have a store and some of it you want to look a little different. And again, I don't know your situation well enough.
See that the pension and
Profit sharing.
on this.
I'm not familiar. Yeah, it's just it's got more lines. It's hiding. Yeah. No, there's so much on even just this one form, right? There's a lot of lines on there. I get you. So for profit and loss from a business, welcome. Got a handout and a sign-up sheet if you'd like. So on this, the top section is primarily just your information about your business, your name, address, employer ID number, your social security number. So it's got social and employer ID number. And then in addition, this red box here, this is what's called the NAICS code. Essentially what it does, it's found in the instructions how to find it. You can also just Google NAICS code for my type of business, whatever kind of business you have. What this code is it tells the IRS, I'm a retail grocery store. I'm an auto mechanic shop. I am a plumber. I'm an electrician. I'm in construction. Whatever your business is, whatever your industry is. And I forget what the acronym stands for, but it's something like North American Industry. There you go. So it classifies every type of business in the country. The reason this is here is so that your expenses for various categories get compared to others in your industry. How does the IRS know if somebody's taking expenses that don't make sense? They just compare you to somebody else. And it could be fair, it could be unfair, but it's how we just double check something, okay? You might not find exactly the NAICS code that satisfies you as your business and what you do. Just find the closest thing. This is not going to hang you up too much, but it is important. Now, related to this, I also like to refer people to a website that I've found very helpful. And there are plenty of websites like this that tell what businesses in every category are reporting that they are deducting. That's public information, believe it or not. So you can look up what auto mechanic shops that run as a sole proprietor are deducting in each of the categories. The website I like is BizStats, BizStats.com. I think it's a good one. There are plenty of others out there, okay? But that will give you an idea that you don't have to reinvent the wheel and figure it all out yourself. And then the other part, just to be aware of, and you probably already know this, comparing yourselves to other people doesn't always work, right? You know, mom and dad shouldn't compare brother and sister. Your brother gets straight A's and you're getting C's. I'll be careful. Same conditions might not apply. Same thing with your business. If you're just getting started, maybe you have a lot of startup costs that a business that's been in operation for years has streamlined, has figured out, hey, here's how I can make my workflow cost me less, okay? But I think that is very useful to help compare when you do get to these categories that you have your expenses in, to see, hey, how do I stack up against other grocery stores? How do I stack up against other hair salons? Okay, and just good info to have. That's what the IRS is using that for. There's plenty of other words on these forms that are difficult to understand. You know, IRS says, did you materially participate? Did you materially participate? Well, what does that mean? Did you throw money at your business trying to get it started, get it running? That's materially participating. So here's some of the terms we're going to talk about here. And over time, I think you'll get used to the idea. Gross receipts. That's everything you pulled in, everything you sold. So sometimes if you got a tape, you know, at the cash register, that might be how you do it. You roll it up, you know, every week, and you add them up for the month and add them up for the quarter and add them all up for the year, right? We also will talk about returns and allowances. That's like you sold something, but then somebody comes back and said, hey, this is not going to work. And so you might have a policy on returns. Yeah, you can return that and get store credit, or you can return that and I'll just refund your money because maybe you want them as a returning customer. But what you don't want to do is pay taxes on stuff that you refunded. So don't forget, and don't just take your gross sales and say, here's all my money that I sold. Remember to keep a track of what your returns were, or what you allowed somebody, or a discount that you applied that you might not apply to everybody, because what you don't want to do is to pay taxes on a product that really you actually didn't sell. I mean, you sold it once, but you had to return it. So that's what that's saying. Your returns and allowances come out of your gross receipts. There's a line on the Schedule C for that. On the back of the Schedule C, you're going to see a formula for calculating cost of goods sold. And really all this is trying to figure out is, how much did you spend on the stuff that you sold, on the products, specifically goods, hard goods. This doesn't apply to services. And it's going to involve figuring out how much inventory you had versus how much inventory was from last year, because you're going to be figuring this out each year. And your cost of goods sold is going to go calendar year. If you're on a fiscal year, you could choose to go June to June if you like. I leave that up to you to figure that out. It's more challenging. Most people go January to December 31st. And that's what the cost of goods sold section is about. And then once you figure out what that is on cost of goods sold, you transfer it over to line 4 on the front of the Schedule C. But what that takes into account is things like the cost of the product that you bought, but also the labor involved. So let's say you have to buy these products and you have them all shipped in, but you have to then take them and assemble them in order to sell them. Remember to take the cost of labor, add it to your cost of goods sold, because you can't just, or maybe you decide, I'm not selling them unassembled. Okay, cost of goods sold. Gross profit is the amount before you take deductions of all the money you took in. Gross income is you've taken out the deductions to actually show what the business had as income. Okay. Even after gross income, though, you're going to be able to deduct other things to show net income. And net income is what you pay the tax on. Okay. Bartering, if you trade your services, bartering, the rules basically are just fair market value. If they charge $250 for that service, maybe your accountant, right? If you give them $250 worth of your product and they say, okay, that's a good deal for me. Great, I'll do your, that project. So it's as if you're receiving income for bartering. It doesn't come up as often, but it is part of it. And there's a section here that just talks a little bit about bartering. I would refer to the instructions if you have that as a big part of how you operate your business. For expenses, every one of the categories in the middle section on the front page, part 2, every one of those categories of expenses is just a typical category. But the question that I get a lot is, all right, I bought glue and we use it in the front office, but a lot of times we're just using it to assemble the crafts that we sell at the craft fair. Is that an office expense like line 18, or is it supplies? Where's supplies? Line 22, right? Frankly, the IRS really doesn't drill down that hard. Okay. So don't feel like, and in fact, I encourage this in general about the IRS in general. When I started, I was like, wow, I'm getting, involved in a strange organization here. I got no idea. Every year taxes made me sweat. And now to keep my job, I got to make sure my taxes are right. So it still makes me sweat. Hate to say it, but no longer do I fear the IRS. Why? Because they're just people doing a job too. And if it's confusing, you're not alone. People who work there are confused. Yes, ma'am.
If you're using that to make your product.
Yeah.
Wouldn't it be in cost of goods sold?
Yeah, you might put it in cost of goods sold. Sometimes you wouldn't necessarily. It really comes down to how your business figures out what you spent. So cost of goods sold works for plenty of people, but I know plenty of people that just, they don't want to use cost of goods sold. It's a complicated one, but you'll see, like you said, under cost of goods sold, there's materials and supplies. It doesn't really, and so this is exactly what I was referring to with the different categories. If you have an expense, put it one place, and then year to year, recommend usually keep it consistent. But if you find out, no, I just need to change that, it's going in cost of goods sold rather than line 19. Doesn't matter where you put it so much as give yourself credit for money you spent. I know a lot of business folks that just have the company card and they just buy whatever the company needs and then put it in the truck and go home and forget that they bought it, maybe forget to give it to their accountant. That means you're leaving money on the table. So it doesn't matter where you put the cost. so much as put it there once and then we call it double dipping. If you put it in cost of goods sold, don't put that cost in supplies on the front. It'll show up somewhere. But some of the common categories are there to kind of spur your mind as to where you should put things. Car and truck, pretty simple. I'm driving something. If you are going to do depreciation, it's a math problem I'm not that good at, but you could spread out the cost of a big purchase. Like if you bought maybe you bought a vehicle that's strictly for business. Maybe you deliver things. All right. Then you can depreciate that vehicle over 10 years. Or you could decide, you know what, I'm just going to pay it all this year because I had a really successful year. I want to deduct that $50,000 vehicle from my costs for this year. Do the math and just guess. Am I going to make more next year? Am I going to make more down the road? You can depreciate things over a different schedule based on just what the lifetime of that item is. So sometimes it helps to just say, I'm going to take 10% every year for the next 10 years of this big purchase, rather than take it all in the year you purchased it. Now that depreciation applies to big things, but any of the products and goods and things like that that you're going to use more or less this year, you will deduct it from that year. Don't forget any of your legal and professional expenses, your accountant, if you had to hire a lawyer. Professional services might even be you have a membership in the Chamber of Commerce. Maybe you have a membership in the industry organization. Maybe you have things like that that are important for that. Deduct them. All your office expenses, including your office computer and things like that, be sure to give yourself credit for it. Supplies, talked a little bit about that. The more complicated ones sometimes are travel, meals, and entertainment. I'm going to show you a little bit about that. That's the one that's very limited. The best you can get for meals is usually 50% as a deduction. For travel, you're going to find similar restrictions. What you want to be able to do, and especially when there's a question, should I deduct this? Can I? Don't be afraid to deduct something that you know is legitimately related to your business. If it's legitimate, all you need is what's called a business reason. The way the law is written kind of says, if a reasonable person looks at your business and decides that's needed for that business, then it can be deductible. And I'll get into travel and meals in a little bit and kind of give you more details on that. Another term that we have is net profit, net loss. That's after all your deductions and your self-employment tax, et cetera. That shows what your net profit or loss becomes. Gross receipts. That's everything you swiped a card for, took cash, got a payment for. Add it all up, that's your gross receipts. Then you back out your returns and allowances. And then if you're just services, the IRS is not going to let you deduct that. So for example, you go in and you just provide a service and you do a job, the IRS doesn't allow it to be an allowance or a return if in fact you maybe have to redo the job. So that's why most businesses that have a service, rather than saying, we're going to refund you if you're not happy, instead, we'll fix it if it's wrong. Okay. Keep in mind, if your business is only service-based, you might not be allowed returns and allowances. Cost of goods sold. It's basically the cost to get this product ready to be sold. So it's the cost to purchase the materials or to make the product. It's, but be aware that sometimes you have that in inventory from last year. So all that the back page, when it talks about inventory beginning of year, inventory end of year, it's basically just saying you got credit for buying your inventory last year on your last tax return. Okay. If it's your first year in business, well, your inventory is probably zero beginning of year. You buy stuff and you get credit for all the stuff you bought and they get to deduct it. So if it's your first year, you won't have any cost of inventory at the beginning of the year. But as things go on, and you don't have to be exact, just, you want to basically don't double dip. Don't take credit for stuff you bought last year, last year and this year. Back it out. Also, merchandise for personal use. Sometimes people have things like that, especially if it's a consumable. Cost of items available for sale, and then take last year's inventory. That's going to be this year's cost of goods sold. Back of the Schedule C has that worksheet. We talked about subtracting the returns and allowances. And what this is supposed to then get you is the sum of gross profit and other income. Instructions for Schedule C are very helpful for this, right? I used to be in the photography business. I used to Schedule C a lot. And it was frequent that I would go to the instructions for line 1 and go, okay, what do I do? Instructions for line 2, instructions for line 3, etc. It's tedious, but the goal is save yourself in income tax. So if you don't exchange money and you're just bartering fair market value, it's taxable in the year that you received those services. Okay. If you have this kind of situation, again, if it is accounting for a lot of your business for barter, read the IRS publication 525. An IRS publication is basically where we take everything that's in tax law and try to just get it in something that we communicate. So if you have a topic that you want to look up, irs.gov. So when people ask about expenses, I basically tell people deduct every single expense that your business pays. Everything. Don't, otherwise you're just not giving yourself credit for it and you might end up paying taxes on that. Okay. But in order to be included, they need to be what's considered ordinary and reasonable expenses. So your vacation to Cancun, be careful. What kind of business do you have? Maybe you actually had real business. Fine. Anything that has real business involved, you can deduct, but be careful that what the IRS considers a tax evasion, and you can avoid taxes, that's cool. Tax avoidance is legal. It's what we're teaching here today. Avoid paying taxes on the money you invested in your business. But ordinary and necessary business expense. And by necessary, if it's questionable at all, just spell it out for yourself so that when you do get questioned from an IRS employee, and it rarely happens, but if it does, just say, oh no, here's why. We needed that. We had to get that. Business expenses spelled out in 535. That publication is available at our website as well. Car and truck is pretty common, and it's also one of the bigger expenses for people. In theory, you base the deduction on the full cost of operating the vehicle. But then it brings up the question of, well, how do I account for the fact that I've got one vehicle and I use it for business and personal? We recommend that you have a log book. Now, it used to be very common. It's all on paper. But anymore, it can be digital. For example, I had one business owner tell me he's got a dash cam that is linked to his phone, and all he does is just press business on the dash cam so that when he starts the trip, presses business, it counts the miles. And then at the end of the year, he's got it all rolled up in a digital format. Business and everything else is personal. So you could divide the expenses based on mileage used. However, be careful about this. One of the things the IRS expects is that an employee who's working for wages pays for their own commuting, right? They pay for the bus, they pay for the train, they drive their own car in the employee parking lot. Okay, that's commuting. You are not allowed to deduct your own commuting costs, okay? Even though you might be using the company vehicle, The IRS expects fair treatment across the board. Employees don't get to take it, neither do business owners. But there's a big decision you're going to have to make, and I think it's an easy one, but you decide based on your needs. You could either use the actual expense of operating that vehicle, or you could use the standard mileage rate. I recommend standard mileage rate. Why? Because you only have to keep records of one thing. How many miles did I drive for business? If you're going to do actual business expenses, you're going to have to account for licensing, insurance, maybe there's a car payment, gas, tires, right? Imagine the list. It goes. So currently right now for the 2024 year, maybe it's for 2025. Again, this is a don't quote me because it just changed at the calendar year, but it's about 70 cents. And I think last year it was like 67 cents. So just check the publication. But the idea is if you had 10,000 miles, you get 70 cents a mile that you can deduct. Then that is supposed to account for all the full cost of operating it. Okay. Now, if you don't like that number, well then, do the actual business expenses.
So I know you're either choosing line 10 on the form F for car and truck expenses versus 19 through 20 or 19 and 20. That's what the insurance.
Not necessarily. You can even have two. So imagine if you, so on a farm, I could easily imagine that you've got, maybe you have an ATV to get from one side of, so that's a gas expense that is not for an on-road vehicle, right? So it's possible you could have both, right? So just keep that in mind, you know, think of a landscaping company. They're going to have all kinds of fuel expenses that didn't go into a vehicle, right? Yeah. Be aware as well for farms, if you're paying for diesel at the pump, you're paying road tax. Well, you could deduct that road tax because you didn't use it on the road, on the highways. All right. So again, there are special considerations for special industries. For vehicles though, back of the Schedule C has information about the vehicle that also is very helpful for figuring out if you're going to take the mileage. It just has a place where you could say, I did 10,000 miles of personal, I did 5,000 miles for business, and I'm deducting that expense. Standard mileage, easier record keeping, and it's going to be multiply the mileage by the 70 cents. One thing we want you to do though is to keep it consistent. So don't change it up from year to year is what we would ask. I don't see people getting in a lot of trouble for this, but it is in the material. So be aware that's what is the official requirement. Claim to actual expenses in the first year of business means that from then on, actual expenses. Here's where this makes a lot of difference for people if they are, if the business itself buys the vehicle. If you're a sole proprietor, you might just buy it for yourself. It's your vehicle, bam. But it's going to matter to your insurance company. It's going to matter here as well, because if you're going to claim the actual expense of a very expensive vehicle, let's say you got $100,000 truck, and you spread it out over 10 years, your depreciation affects that. So claiming actual expenses, it might be a much better deal for you on a very expensive vehicle, especially if you have lots of repairs. You know, maybe you're beating it up more than the average person. So your repair expenses might be much higher. Maybe your insurance company said, hey, for that kind of business, we're jacking up your auto insurance rate significantly. So you're going to have to account for a higher rate. Do the math. I think 70 cents works for a lot of cars and trucks, but it might not be enough for you. So you might want to do under either method. Don't forget parking. Don't forget tolls. Don't forget ferry, right? If you're going over, whether you're going, you know, peninsula or back, you know, you're going to be mainland. Is that what we call it? Thank you. You know, that's $20 each way. So don't forget you get to have this as part of your auto expenses. Okay, so no. Okay, so again, this is gonna be considered commuting. But I can think of reasons why you could have certain days that I'm meeting with a client in Bellevue, right? So your business in Seattle, but you're going to a location, then the whole darn trip is including those parking and tolls. Yep.
Got David here because I went to the small business fair as well. I definitely that whole trip. The mileage, the ferry, I don't really any parking to call it, but
Because it's not a typical, because that's not a typical thing she does as part of her commuting. Just going to your business, that's going to be considered commuting, but there's a lot of reasons why, you know, you're not just going to the place of business, you're going to a job site, meeting with a client, things like that. You had a question?
Yeah, so, I commute up Island for my day job. I have a ferry pass. So if are you okay to just keep it in the log that you travel up Island? I don't necessarily have a receipt for that trip.
Oh, that's fine. Yeah, again, anything written documentation counts. Worst case scenario, let's say somebody says, hey, you claimed a lot of ferry mileage or tolls. What do they call them? Fares. You claimed a lot of fares. Do you have the receipts? Well, go to your credit card company, go to however you paid for that pass and just show that and then explain 75% was for business or however the percentages work out. Okay. In other words, this is kind of a strange thing to admit, but if you have a rationale as to why, be able to just explain it. That's what happens in an exam or an audit. And those words come across as very threatening. Like, what are they doing? Are they going to, well, all it really is coming down to is in certain cases, prove it. And don't even be concerned whether you did something wrong. Some audits are just at random. In order to keep it fair, they just, instead of having, so anything that has an obvious red flag, IRS is going to say, hey, here's an appointment at the Everett office, come on in and let's talk. Or, you know, it was at random. Not that there's any red flags. They just want to say, can I see your receipts? And I was actually involved in an audit myself. And at the time I worked for the IRS and I was panicking. But really, when I got to the office, I realized, well, I brought the paperwork they said to bring. Here's the paperwork. They go, yep, 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 yep. Have a nice day. Okay. So keep in mind, if you have a rationale as to why this business, or sorry, this trip was business related versus this trip I don't deduct because it's my commute, fine. They'd be able to explain it. Schedule C instructions again. I didn't print it, it's much longer. Most everything that I'm talking about today can be found just by going to irs.gov/small business. Another easy way is just Google and look for the IRS result that comes up. But most of these things can be found here, and you're going to find way more than just what the topic of this class is. And so be aware there's lots of stuff there for you. So depreciation is basically to give yourself credit for any kind of business property. Vehicles are often depreciated, but sometimes if you're a landlord, right? If you have 3 or more properties that you are renting, you can classify yourself as a business. So you can depreciate the cost of owning this property and work with your accountant on that. But it basically just means figuring out the normal life cycle of it and depreciating it. Land, sometimes your inventory, right? If you have inventory that over time becomes less valuable, right? Think of anything where they change the model year to year. Last year's inventory is going to be worth less. So it gets to, how do you show that it's worth less, right? Depreciation, right? And it wants to know details about when did you start using it? That's what placed in service means. And that's what retired means. But if something doesn't have, in other words, if it's placed in service and retired in the same year, it's not depreciable, right? Inventory. A lot of times you won't depreciate inventory if you bought it and you sold it same year, and it's not going to decrease in value just by holding it in your warehouse. Okay. So if it's 1 year or less than a year, that's not depreciable, right? You have other costs, but if you're depreciating something, it starts when it's first used for business and it ends when it's no longer used, or it's fully recovered. So think about it this way. You got a vehicle, it's supposed to last about 10 years. You could take 10% for the next 10 years until you fully recover the cost. Once you fully recover the cost, you cannot then deduct the cost of owning that vehicle and depreciate it. You could still take the oil and the gas and maybe just your 70 cents a mile. But after that period of depreciation, you can't take more than what the full cost of the item was. Okay.
Is depreciation, or like buy something new, it seems exponential with the depreciation on it. But if you get something new, maybe depreciates at a different rate.
Yeah, that might be the case. If it is, then you'll calculate it at a different rate. I would lean on your CPA on how much that is allowed. I know that what's more typical is linear, just straight 10 years, 10%, right? Check the rules on depreciation as well to see, because sometimes it's item specific, right? Like vehicles, for sure, depreciate a lot in the first year. Land is not expected to depreciate as much, but keep in mind with land, we watch the price go up, 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 up. You don't get to deduct the full value, you get to deduct your full cost. So check the instructions, and maybe it is better to depreciate it up front. You and your accountant figure that out. Yeah.
Is it possible to depreciate like a used piece of equipment? So
Yeah.
Say a piece of farm equipment that you buy used and then in 5 years, it's just no longer usable.
It is depreciable that way. Yeah. And in fact, let's suppose you counted on it being 10 years of depreciation, but you only got 5 years because it catastrophically failed. Then that comes under a different category, a loss, right? I expected to still have 50% of the value in it, and I can't depreciate it because it's gone. It's retired, right? But I lost a big piece of equipment and I bought it, so I want to get credit for it, so I don't pay taxes on that. Yeah. On depreciation, you've got a lot of technical topics. That's one of the reasons why I think you, your accountant, and your partners, whoever, should figure out what ways you want to do things. And this is where you have more and more technical details. Modified accelerated cost recovery system. I think that is where you're going to find your accelerated depreciation come into play. Okay. So it's a modified accelerated cost recovery where you're getting more depreciation in the earlier years. Okay. Similarly, Section 179 covers these deductions to recover most of the cost in the year that it was placed in service. Sometimes that makes a lot of sense if you have a really good year and that piece of equipment was just bought for that job or for that particular year or whatever. Keep in mind though that costs that you have for something you're going to depreciate is limited to your total taxable income for the year. So this is another reason why I say do the math. In other words, if your income for this year is only a certain amount, you can't write off all of that, then you might not want to put it all on that year. You might want to spread it out further to help you out next year and the year after. And it also basically, this last line, it just means anything that is a not-for-profit activity, like personal. Real simply. Used something for personal use, it doesn't apply there. So publication 946, that's where you'll find your details on, hey, can I speed it up? Or should I just even spread it out? These are some recent changes. First year depreciation deduction can often be called the bonus depreciation. Again, this is where some people just elect, hey, I want to deduct it all this year. Okay. Instructions will have information about that. Form 4562 is part of how you document your depreciation. Also know that this stuff changes frequently. So this is in effect for 2024, the filing season that you're going to file either in April or October of this year. Not clear on whether this is going to, all the rules are going to stay the same. So just be aware of updates. Any legal and professional expenses you should be deducting. And a lot of people sometimes forget about ones that don't always come to mind right away for these kinds of things, right? But any, of course, accountant and attorney fees, sure, that's a professional service. Maybe you have somebody that comes in and a consultant that looks at your business. Maybe you have a trade organization that comes in and inspects your business and you have fees involved. Whatever way you have fees, deduct that. Tax advice and tax prep, any of that stuff, of course. Office supplies and postage. All seems pretty straightforward. And then your supplies. Try to just look at what you bought this year and used this year. That's one of the reasons why the cost of goods sold sometimes is used more than just things like this. But also, it's basically just to say your materials and supplies, deduct them. Also, books. Now anymore, it might be online. But if you pay a subscription to an online resource, like I used to, when I was a kid, I was an auto mechanic. And there's a book called the Chilton book. Well, it's not one book, it's like 50. And at the auto shop, they're on the shelf and you could go pull it out and look at the schematic of whatever job you're doing. And that also tells you what they think the retail should be, et cetera, et cetera. Anymore, that's this online subscription, right? It's not a book, but anything that you pay in order to stay up on your business, right? Do you have a subscription to a trade magazine? That counts, okay? Professional instruments, things that are specific to your business, you should be aware of those. And I'll tell you this, your accountant does not know. And you go to your accountant to be the tax expert, but they are not an expert on what you are as the business owner. So if you make crafts and sell them at the craft fair, they don't know that, oh, I had an unusual expense that day, right? So keep in mind that although they know all the categories, they might not know what you do on a day-to-day basis. Yeah.
So related to that, where on this form, where would you put software?
It's either, you could put it in a couple places, but I would think professional services. Or even office expense, 18. But I think either 17 or 18. Again, it's not going to be as strict there. Like QuickBooks. Exactly. That's how you, a lot of, if you're doing payroll, that's how you're doing your payroll taxes. If you're doing it annually. In fact, QuickBooks is also, though, if you keep up on it, it's a way to tell you, did I bid that job right? Are we making a profit? Last month, did I do okay? Right?
Subscriptions for softwares that go into making the thing. So I do put those in supplies because it is a thing I use to make what I sold. It's not used for me.
Great. Yeah. Yeah. And in fact, when it comes to specific things like that, I wouldn't worry so much about that section 2 there. about getting it in the wrong category. I mean, that is a common question about this particular thing. Oh, I put it in the wrong category. That's not advertising. That's this. Okay, fine. I still paid that, and it has a legitimate business reason why I bought that. If it goes beyond a year, that's when you should be doing depreciation. That's when you should be spreading it out over a year, right? And this is where goods, sometimes they roll over year to year, and you just back out the ones you had from last year. But especially bigger items like tools, you could either decide to take them all the first year, or you could spread them out. It's recommended that you spread them out, but in point of fact, this really only applies to big dollar items, right? If you bought something that has a life of more than a year, but it didn't exceed your total income, great. Deduct it in the first year you bought it. Sure. You could deduct it all the first year. Yep. And anymore, a computer might not be as useful next year because you need new software. But yeah. That's expected, right? I don't remember the exact verbiage, but it basically says there's an allowable, reasonable amount, right? So, you're doing business, then it's lunchtime and everybody's having lunch. And then, I don't know, you're looking up stuff on the news. Well, that's in theory personal use, but it really doesn't come up as much. And what it basically just says is, yeah, it's expected that you're going to have a reasonable amount. This is a difficult thing because people are like, what's reasonable? I don't know. It's in my home office. It's the computer I have, right? Last night, I watched a video on my wife's work computer. It's very similar to what we talked about for the car. You have the total cost and you want to deduct a part of that cost in a number of years. And then it stops when you've deducted all the costs of the computer. So if it's a $500 computer and you just figure out $100 a year, 100 for 5 years, and you're done. And it might last longer than that. From then on, you're only deducting costs like usage, which come under a different thing, which we'll get to. Travels, meals, and entertainment is a lot more restrictive than most, but don't forget that this might come up, right? So I will say that it used to be widely abused, and this is why TCJA, Tax Cuts and Jobs Act, I think that went through in 2017, changed a lot of that. So these are the new restrictions, but they're basically designed so that you're not paying for all your groceries, paying for all your pet food, paying for your vacation, and having all these things run through your business, okay? The very awkward word commingling is the term the IRS uses for combining your business and personal stuff into one checking account, one credit card, right? That's where you're going to have trouble figuring out what's a personal and what's a business expense. So it's highly recommended you have a business checking account, you have a business credit card, right? If you have a loan, it's a loan that to the business, et cetera. Whenever you mix them, you're going to have trouble proving to the IRS, maybe, if it comes, what was legitimately personal versus business. But that being said, don't be afraid to take a legitimate business expense. So you can deduct 50% of the cost of business meals. What's a business meal? You're taking a client out to dinner just to talk. Here's the sales pitch, right? Some people I know meet people at a Starbucks and they'll buy their client coffee. Okay, fine. 50% of the cost of the total, including your meal, is deductible. However, for for a certain period of time, 21 through 23, the IRS was subsidizing something else. They wanted to say, okay, you can get 100% for 21, 22, and 23 tax years. Why? Because businesses were struggling during the COVID crisis, especially retail food, right? So keep in mind, these laws change all the time. The instructions are there for you to refer to. But here's other check boxes that you could check to figure out, hey, is this really a business expense? Well, the owner or employee was there, right? It's not like you called up the local restaurant and go, hey, everything's on me. Give him anything he wants. That's not a deductible business expense. Why? You're entertaining your client, but you're not necessarily there doing business. Okay. That's how you connect it to a business need. Also, not considered lavish, right? And what's lavish to you might not be lavish to someone else, but a significant, if your dinner is way out of the norm, they're going to wonder, was that really necessary? You took them to Vegas? Did you really need to do that? What was the reason for going to Vegas? Oh, he's a great customer. Okay. However, if you're downstairs, right, or if you're in Langley or in your Coopville and you're at a normal restaurant, I don't think there's I wouldn't call much of what most people consider a normal restaurant they'd go to lavish, right? Think things like resorts. Think things like, something out of the ordinary. Also, the meals that you provide to business contacts. Sometimes you'll do it in office, right? Some people might have a refrigerator just specifically to welcome customers. Right? You walk into the barber shop, they've got a cooler there or whatever. Okay.
Is something tangible not in the meeting?
No. Sometimes you'll pitch people that won't buy your service. It's just still a cost of doing business. You tried. And hey, I went there specifically and they just chose somebody else. Okay. Oh, now, all right. So let's think about this completely differently, right? If you go to a conference or a show, you're going to have a much stronger, this is not travel, meals, and entertainment necessarily, as much as this is a professional development. It might be part of your educational expense. It might even be an advertising expense. So here's how to put this in perspective. Let's suppose there's a silent auction for maybe Goosefoot, right? You've got a silent auction and you bought a ticket and you donated a gift basket or your services, right? So you donated $1,000 retail value of services and you bought the ticket. Those are both deductible and you could call it advertising. Now, why? Because your goal is not just to have your name on a list. Your goal is, I did that to get more customers. I did that to impact more people. Yes, you donated to a worthy cause, but you get to deduct the fair market value of what that retail product is because your purpose was advertising, generate more business, get your name out there. Yes. We wouldn't call it benefit programs. Yeah, I know that's deductible. I just don't know the line offhand. Yeah, I don't see right offhand, but I'd think either 17 legal and professional services. Benefit programs, think of things like you give your employees educational benefits. If they work for a year, you give them $1,000 for their tuition, or you other things that are meant basically as benefit programs, like maybe childcare, things like that. Yeah. Again, it might be legal. I'm thinking legal and professional services because you're being certified by an outside agency. Now, again, I don't think the category matters so much as just, hey, don't forget. Oh yeah, I just pay for that every year. And one of the reasons why I think people forget stuff like this, imagine if you've had the subscription to Popular Quilting forever. But then you decided this year, I'm going into business as a quilter. Well, from then on, Popular Quilting is part of doing business. Okay. Yes.
When it comes to the owner or employee needing to be there,
Mhm.
how do you prove that?
So some of these things an IRS employee would have no way of proving. Really, it just comes down to, yes,
By trust.
it's record keeping, right? If you have a receipt that's just a restaurant receipt, it's not always clear, why is this deductible? So if you do take a client out, or if you do take the employees out, you can deduct part of it, then just put on there client, 15 client.
So,
Yeah.
so should we, yeah, have this, yeah, what employees were there, who else was there, like on the back of.
That's a good idea. I hadn't thought of that, but it makes sense. My only thought was just to, have it somewhere, and I would put it on their seat if it were me, but just I deducted it because I took somebody out, or that was my employee that took them out.
We started to get like a spreadsheet, but you wouldn't print those necessarily until you were like audited.
Exactly, right. Sure. It's kind of funny that in my experience, I've run into that sometimes where people will put all the worksheets and all the different, and I'll get a tax return that's, a book, when in fact only 10 pages are needed, or 5, So don't feel like you have to have this documentation to send to us every year. Just have it in your back pocket if you need it, because frankly, we charge more in penalty and interest if you get something radically wrong than any other agency out there. So this is more about trying to just, hey, do the right thing and protect yourself. Do I expect you to know every little detail? No. And that's also a good point to make, is don't feel insecure if you don't know every rule. To kind of back that up, I use this story a lot. One of the groups that Congress has to make sure that IRS is not treating taxpayers unfairly is called the Taxpayer Inspector General for Tax Administration. That Inspector General reports to Congress every year and gives a speech to Congress about here's what the IRS is doing or not doing. And over the years, we've had plenty of improvements that Congress goes, yep, thanks, Inspector General, we're putting that program into place. The Inspector General that gave a speech a couple of years ago had been doing it for 30 years. Her education is as an attorney. So she's had 30 years as a tax attorney working in a high profile job for the IRS. And she fully admitted to Congress that if anybody ever asks me a tax question, she said, I'll get back to you. And she says, I get a team of lawyers to figure it out. Even someone as experienced as that has no idea, really, of all of everything. And it's the same with me. I'm telling you the best I know, but I'm no longer a business owner, and I'm not an accountant either. I'm not even an accountant. So I'm trying to guide you to know that it can be figured out. And if your business needs to figure it out, there's instructions. But again, just doing the best you can is enough, right? For your records. How do I know? How do I know which employee was there? Well, the best we can. And if it comes up later, gosh, I don't remember, but I know that was a business credit card. Bam, that's your proof that it was a business. It wasn't just that you sent some customer out and told them, go downstairs to Bayview and get anything you want, So this is also a key though, when we talk about travel, like you talked about conferences, right? You go to a conference, you might be able to deduct all of the lodging and transportation. Okay. Why? Because you wouldn't have gone there if that conference wasn't there and you didn't need that conference to stay current in your industry. Maybe you're an industry that needs continuing education credits every year. Maybe every year you have to pass a certification test or pay for a license. So we are talking about what's your tax home. Tax home is the main place of business regardless of where you have your family home. So you mentioned you travel to mainland. Okay, fine. That's your tax home. So if you're staying overnight anywhere which is not where the business is at, you have the right to deduct that because you wouldn't have done it otherwise. And then meals for these that are business related can be deducted. Usually we recommend the standard meal allowance. You need to keep records of these, but the IRS has under the U.S. General Services, GSA.gov, they have what are called per diem rates. Okay. And a per diem rate basically just says, hey, based on the averages in this area, this is what we will pay for an overnight stay for lodging and for meals and incidentals. And it's a standard rate. And I forget what it is, but every city is a little different. I think Seattle's about $90 a day for meals. And I forget what the number is for lodging. But the point is that this gives you some of the per diem lookups so that if you have an employee, you might say, hey, I'm going to reimburse you on your on your paycheck for your meals. I'm going to give you $50 a day, whatever the per diem for that location is. Let's say you've got a job on the north end of the island. You don't want them to commute. So you put them up somewhere, your employees, hotel costs, things like that, you can all have as business costs. To be sure you're getting it right, publication 463 and publication 535, it basically just lets you know. And again, it's about record keeping more than anything. Just keep a record of when, where, who was there, and why did you do it? And a lot of times that just goes on the receipt. Maybe you print out the email invite and put it in there, whatever. So when you're calculating this, your Schedule C instructions are going to let you know, hey, where to put things and then how to keep all the lines. You know how the IRS says, put that on line 6. Now carry that over to line 47. Now go back over here. So you're going to start with your gross profit. Any other income, like maybe you got some interest income from your bank, not a lot of money. Maybe you got investment income. Maybe you get a rental of something, whatever. You add that stuff in. That's your gross income. Take out part 2. So part 1 is where you list all your income, right? And you've got things like your gross receipts, returns, you take out of that. From the back, you maybe have cost of goods sold, or maybe you're all services. So you just leave that line blank. That's your gross income, or that's your gross profit. And then you add your gross income from adding any other income you might have, incidental income. Part 1 there, deduct then part 2. You also, if you use your home, or if you have a shed out back, or if you have a garage, whatever is 100% used for business, if it's part of your home, you get to deduct the costs. That's a part of a separate class, okay? All the info is at irs.gov, but I'm going to be teaching that in 2 weeks, no, not 2 weeks from today, 4 weeks from today. So 4 weeks from today, I'm going to be talking about business use of your home. It's one of the more detailed ones, but if your garage is 100% all your business, be aware you get to deduct the costs. What kind of costs? Your rent or your mortgage, your insurance. Now, not all of it. And just to simply give you what that class is going to cover, square footage of your business area is the percentage of how much of the expense. So if it's 20% of the square footage of your house or your home, then you get 20% of the expenses. Okay. then that gives you your net profit. Again, refer to the schedule in C instructions. Yeah.
Is that under like 21?
Yeah. Yes. Yeah, like that's your office rent. Okay. Here are some other possible deductions you might have on your 1040. Health insurance. If you're your only employer, well, you might be paying a lot for health insurance. That's something that you get to deduct 100% of the premium. Similarly, you could have self plus family. And as a sole proprietor, self-employed person, you get to deduct self plus family, not just self the owner, okay? Same idea for retirement plans for small business. Publication 560 will let you know how to take a deduction for a plan that you set up for yourself. And think about what you're doing here, right? You got your income and maybe you take 50,000 in income, but there's an extra $10,000 that you put towards a retirement account. That means you don't pay taxes on that 10,000 this year. You get to have it in a retirement account. So effectively, it's kind of like giving yourself 60,000 in income, but only paying tax on the 50. Why? Because the part that's put in the retirement plan, well, you'll pay taxes on it when you actually draw that money out. Okay. So when you have a startup of a business, a lot of businesses are going to be capital heavy when they get started because these are all brand new expenses and you don't have any revenue yet. So you're just basically paying it out of your savings, right? So startup costs, if you're creating a new business or even if you're investigating the business. Okay, so let's say you signed up for a convention and your business hadn't even officially started. But later that year, you do start the business. Well, then that can become part of your investigation or creation of the business. Again, read publication 535, but give yourself credit if in the year you started your business, you spent a lot of money running around doing things that potentially could be a business expense, but then because you didn't have any customers, you didn't think to deduct that it was deductible, right? There's a lot of startup costs and we want to give you credit for that. So you're working for an employer. They promise you $100, I don't know, a day, right? But they're going to deduct Social Security. They're going to deduct Medicare. They're going to deduct, let's say you said, hey, withhold 10% of my pay to go towards my taxes at the end of the year. That's a W-2 employee or a wage earner, right? So if you've done that, you understand that, oh yeah, you were promised $100 a day, but look at that check, it's 75. Means the employer then is responsible for depositing those payroll taxes to the IRS and then depositing your withholding as well, so that under your Social Security number, you've got that money in the bank already at the end of the year. But if you're self-employed, there's nobody doing that for you. So your taxes are going to look higher in part because you've got a self-employment tax that not only covers the employee portion of the Social Security and Medicare, but also now you're the employer, the employer's portion. So in a sense, you're going to see those be double what they were when you were an employee, because as an employee, you pay half, employer pays half. Since you're now your employer, you're paying 100% of it. So what do you include? Well, once you get down to the bottom line on this Schedule C, net profit or loss, line 30, 31. If it's a profit, enter it on the 1040, it says, and on the Schedule SE. So what are you being charged Social Security and Medicare on? Only on the profit. Only on what you got to take home as a business owner. So that's where it's the bottom line after you've already taken out all these Section 2 expenses. so that you can then get to the Schedule SE where it calculates what that is. So you're going to include, if you're a sole proprietor, a 1040, a Schedule C, and a Schedule SE. You might have lots of other schedules. You might have investment income. You might have, if you had significant medical expenses or mortgage, et cetera, you can deduct on a Schedule A. But at a minimum, think 1040, Schedule C, Schedule SE. Do a paycheck checkup. What they're saying about that is that if you are paying yourself during the year as you break it out and you haven't put in enough in an estimated taxes, the bill comes at the end of the year and it can be challenging. So that's where I would look at the tax withholding estimator. Also, work with your accountant on it. Or an easy way to think about it is, last year I made 50 grand. Let's make it 40 grand because I can divide that into quarters easier. Last year I made 40 grand. That means each quarter I made about 10 grand. So I deposit the taxes about $2,500 per quarter. So that at the end of the year, if my taxes are 10 grand, I've got 10 grand already there. Okay. That's what we're talking about when we say pay estimated taxes. Recommended is quarterly. Okay. 4 times a year. I'll tell you, I once had a guy when I was a revenue officer, he was a handyman, not a big business. He's just getting jobs on a daily basis, getting cash for those jobs. He worked in an apartment complex for the apartment company, and he would just go fix things, right? But he was not good at math. And I talked about keeping your records and doing it quarterly and all these things. It's just way too complicated. And it wasn't a ton of money from some perspectives, but from him, it was a huge amount of money. So he's like, how do I keep out of this problem next year? Right? We set him up on a payment plan, fine. But how do I keep out of the problem? Well, I said, put back 10% of each job rather than figuring it out by quarter. Every time you get paid, take that 10%. You can go right onto irs.gov and under your social security number, put your estimated tax in. Well, he wasn't that good at math. He's like, well, what do you mean 10%? For every $100, $10. Okay, keep it simple. Put some money back. And do you have to be exact? No. Estimated taxes is more about having the money there so that you don't get in trouble at the end of the year, right? Yes.
Like you have to have a separate form or something like if it varies. Yeah, because we like to go by what we made in that quarter and then
Right.
pay our estimated based on what that profit was.
Right.
But I thought that I heard we had to do like an extra form saying why you're inconsistent from quarter to quarter with the amount. And then I think I also, one of them, if you are short, get penalized.
Yeah, you can be penalized. So there are 3 ways. I'm going to start with the penalties and I'm going to work back to some of the other, because there's like 3 things going on there. If you don't pay enough in estimated taxes during the year, you can get penalized. It's not a huge penalty, but why bother paying the IRS anything for a penalty if you can avoid it? Here's how you avoid it. If you paid in as your estimated taxes an amount equal to what you paid last year. So the logic there is you've been running your business, you made a certain amount and you put in the estimated taxes last year and you paid it off. But let's say your taxes were 10 grand last year. And this year you had a blockbuster year, but you didn't really realize it until you did the taxes. And wow, I'm way different. If your estimated taxes were as much as you did the last year, you don't get penalized for having a good year. Okay. So if you paid at least as much as what you did last year, or if you paid in as estimated taxes 90% of what your tax actually worked out to be, in other words, if you're close but 10% short, you're still not going to get penalized. Okay. But if you're short significantly, yes, you could be penalized. And so that's why, like you said, it's prudent. There are these extra, and in fact, there are forms for the estimated taxes, not really going to go into that right now, but anymore, a lot of it's electronic. You just go online, make your deposit, estimated tax, you're done.
That says that, hey, our business is inconsistent from quarter to quarter.
Yep.
You know, but we last year still got penalized, again, it's a stupid penalty, but penalized because one of the quarters was short, like, or we didn't make that much, that one particular quarter, and it just happens to do with when people pay.
Yeah.
You know, but this one quarter was pretty small, which probably what triggered the penalty was it was less than what it was the year before, but we had that form saying specifically that we.
So
had the inconsistency.
I don't know all the details on why or how, but I would just say as a general principle, some penalties, the only way to avoid them is to throw lots of money at the estimated taxes. So you always get a refund. But also in regard to any particular penalties, you have the right to appeal the penalty. And a lot of penalties are prescribed by, I mean, here's how it works. A tax analyst figures out what the penalty should be and tells a computer how to do it. So a lot of times you're getting these penalties based on what's typical and what a computer program was told to charge penalties on. Well, a human being can come in and go, oh, your business fluctuates, it's seasonal. Boom, there's your reason. I have a seasonal business. I make all my money from, April to August, because that's when farmers markets, right? There's reasons in it.
Fix that.
Not necessarily. Appeal doesn't mean take it to court.
And like, $3.
Well, $3.
Dumb, but I was still thinking like, but we have this form, that we told them ahead of time that, that we're inconsistent and why am I still, and then for the longest time, I had no idea why.
Thanks.
In fact, just your explanation now was like, oh, it's probably because I fell below that, from the year prior, and that's what they're looking at. But the whole point was we have this form saying that we are inconsistent. So how am I getting triggered for penalties?
I don't know enough about the situation to know exactly why. Think about it this way. When the government thinks that there was money that was supposed to be in their coffers that the government's getting interest on, then that's what that penalty is. They're charging you what would have been interest if that money were in our hands. I mean, and no, sometimes I tell you, I'm with you there. I wonder. Recommended that you sign up for EFTPS. If you're an employer and you have employees, you are already signed up for this. It is a requirement when you have payroll tax to use the EFTPS system. And what is that system? It's at eftps.gov. You sign up for an account, you'll get a password, you'll link a bank account to it, and it just means you can log in and schedule a payment for next week, or you can log in and check your record for your last 6 months of payments, or you can go in and just, hey, I'm expecting to make my estimated quarterly. You can make lots of different types of payments with this. You can have it either for your employer ID number or for your social security number, and possibly for both.
And you're going to be, but with regards to the EFTPS, like, why we ended up having to do two separate, like doing the 1040 under personal.
Yep.
And not being able to do it under the business one.
So the reason why is that there's not a strong connection in the IRS systems between an employer ID number and the individual. And some of it comes down to what we're legally able to do versus not. So strangely, if you made it under the business, the money would still be there. It's just that the computer doesn't know to just transfer that to your taxes at the end of the year on your 1040 under your social security number. Yeah, they're linked in our system and we show that the owner of this business is that employer ID number, but in theory, they're completely different identities. So money deposited under one that's meant for the other, it's not going to automatically be moved. You would have to call us up or make an appointment and say, hey, could you move that? That 10 grand is meant for my personal.
Themselves would even show up, but like I couldn't get a 1040 to show up under any of our businesses. I had to
Right. Oh, exactly. Yes. So it's going to ask you what you're talking. I think I changed pages. Well, anyway, EFTPS, it's gonna ask the reason for the payment. And if you put reason for the payment, you won't find Form 1040 under an EIN. Exactly, yep.
But it's kind of awkward because I have to move money from the business to our personal account, and I always
Yep.
get drilled by the bank, like, why did you, cause it's a lot of money. And they're like, why did this money come in and why did that money, go out? And it's like, "Well, 'cause the IRS makes me, I have to switch accounts in order to pay it, because it won't let me pay from the business account.
One thought might be, as you're doing it, give yourself what's called a business draw and just pay yourself a regular, like make that transfer regular and break it up into a bunch of different pieces. That way it's constantly going, you could do it quarterly,
Okay, yeah.
you could do it by month.
But it's-
Yeah, so maybe break it down by month and your bank won't think it's a big deal. I don't really know. So again, self-employment tax, Schedule SE, and it's any combination of your Medicare and Social Security tax. It's basically on your net income after the deductions. So what did we cover? We covered the basics of Schedule C, refer to the instructions for more details. Hopefully now you'll be able to figure out, hey, this is my income, but here's really what my profit is. Identify your deductible expenses. The standard is pretty much anything directly related to running your business that is reasonable and typical for businesses in your category. And there's a couple of other areas besides Schedule C that your 1040 is going to have, like business, retirement plan deductions, your qualified business income deduction that we talked about at the beginning, that 20%. And don't forget your Schedule E and your self-employment tax. For more details, irs.gov/small biz. That's my contact info. If you'd like a business card, I could hand out business cards as well. What I'd want to hear from you folks is just, hey, if you have problems down the road, we want to know. Part of my job is not just giving presentations so people get to know a little bit more about taxes, but it's also collecting what's not working. So if you have something that you logged in and you tried to figure something out, and it isn't working, my job is to tell the people up the chain from me, hey, this isn't working. And it happens all the time. In fact, as a result of this meeting, one of the things I'm going to pass on is exactly your point about a sole proprietor has an EIN and a Social Security number, and it's hard to get the deposit where they belong.